Welcome everyone. This is Dr.A.Sivaranjani, Assistant Professor, Department of Business Administration, Coveri College for Women. In this video, we are going to learn about management accounting. From that, I am going to explain about meaning of ratio analysis and classification of ratio analysis. Ratio simply means one figure expressed in terms of another. A ratio is a mathematical relationship between two items expressed in a quantitative form. Classification of ratio analysis. Ratios are classified into liquidity ratios, solvency ratios, profitability ratios, activity ratios, and capital structure ratios. Let us discuss with one by one. Liquidity ratios. This type of ratio helps in measuring the ability of a company to take care of these short-term debt obligations. A higher liquidity ratio represents the company is highly rich in cash. The following are important liquidity ratios. First one, current ratio, and second one is quick ratio. Current ratio. Current ratio is the relationship between current assets and current liabilities. A current ratio 2:1 is considered ideal. The formula is current ratio is equal to current assets divided by current liabilities. Quick ratio. Quick ratio is also called as asset test ratio or liquid ratio. It is the relationship between quick assets and quick liabilities. Quick assets are those assets which are readily converted into cash. The formula is quick ratio is equal to quick assets divided by quick liabilities. A quick ratio of 1:1 is considered satisfactory. Solvency ratio. Solvency ratio assesses the long-term financial condition of the firm. Bankers and creditors are most interested in liquidity, but the shareholders, debenture holders, and financial institutions are concerned with the long-term financial prospectus. The following are the important solvency ratios: debt equity ratio and proprietary ratio. The first one, debt equity ratio. Debt equity ratio establishes the relationship between shareholders fund and outsiders fund. Outsiders fund include all long-term and short-term debt. Shareholders fund consists of preference share capital, equity share capital, and reserve and surplus. The formula is debt equity ratio is equal to debt divided by equity, or outsiders fund divided by shareholders fund. Next, proprietary ratio. Proprietary ratio is the relationship between proprietors fund and total tangible assets. The formula is proprietary ratio is equal to shareholders fund divided by total tangible assets. Proprietary ratio indicates the proportions of shareholders funds in the total asset. The third classifications of ratio analysis, profitability ratio. Profitability ratio measures the profitability of a firm's business operations. This ratio may be related to sales or investment. The important profitability ratios are gross profit ratio, net profit ratio, operating ratio, and return on capital employed. Gross profit ratio. This ratio expresses the relationship between gross profit and net sales. It indicates the efficiency of production or trading operations. A high gross profit ratio is a sign of good management, as it implies that the cost of production is relatively low. The formula is gross profit ratio is equal to gross profit divided by sales into 100. Next, net profit ratio. Net profit ratios are calculated in order to determine the overall profitability of an organization after reducing both cash and non-cash expenditure. The formula used for the calculation of net profit ratio is net profit divided by sales into 100. The third profitability ratio, operating ratio. Operating ratio matches cost of goods sold and other operating expenses with the sales. Operating expenses include selling and distribution expenses and administration expenses. Operating ratio is equal to cost of goods sold plus operating expenses divided by sales into 100. Next, operating profit. How to find out the operating profit? The formula is operating profit divided by net sales into 100. Next, profitability ratio, return on capital employed. In this ratio, the relationship between profits and the capital employed. It is most widely used to measure the overall profitability and efficiency of the business. The formula is return on capital employed is equal to earning before interest and tax divided by capital employed into 100. The next classification of ratio analysis, activity or turnover ratio. Activity ratio measure the efficiency of asset management. Activity ratio indicate the relationship between sales and various assets of the firm. The important turnover ratios are stock turnover ratio, debtors turnover ratio, creditors turnover ratio, and fixed asset turnover ratio. Let us discuss with one by one. Stock turnover ratio. This ratio indicates the number of times stock is turned over during a year. The formula is stock turnover ratio is equal to cost of goods sold divided by average stock. Next, debtors turnover ratio. This ratio helps the company to know the collection and credit policies of the firm. It measures how efficiently the management is managing its accounts receivable. A high ratio represents better credit policy as compared to a low ratio. The formula is debtors turnover ratio is equal to credit sales divided by average debtors. The average debtor is equal to opening debtor plus closing debtor divided by 2. And the next one, average collection period. The formula is month or days in a year divided by debtors turnover ratio. Next, creditors turnover ratio. This ratio shows an average the number of times creditors are turned over during a year. A higher ratio indicates quick settlement of dues, and a lower ratio reflects liberal credit terms granted by suppliers. Creditor turnover ratio is equal to credit purchases divided by average trade creditors. Next, average payment period. It refers to the number of days taken by the firm to pay its creditors. Average payment period is equal to creditors plus bills payable divided by credit purchases into number of working days in a year. Next ratio, fixed asset turnover ratio. This ratio indicates the relationship between sales and fixed asset. The sales generated by every rupee invested in fixed asset. A higher ratio is an indicator of greater efficiency in the utilization of fixed asset. Fixed asset turnover ratio is equal to sales divided by net fixed asset. The final classifications of ratio is capital structure ratio. Capital structure ratio is also known as capital gearing ratio. It is used to analyze the capital structure of the company. It establishes the relationship between fixed interest, dividend-bearing securities, and equity shareholders fund. The formula is capital gearing ratio is equal to preference share capital plus debentures plus long-term loans divided by equity share capital plus reserve and surplus. I hope you understood the classifications of ratio analysis. Thank you.